Assalamualaikum warahmatullahi wabarakatuh. Hello everyone. So in this video I will explain to you the concept of recognition and measurement of liabilities, which is the topic that gives us the understanding of the basic of recognition and measurement of liabilities in financial statements. So the first one is understanding and importance of obligation itself. So an obligation is a present duty that must be fulfilled by an entity in the future as a result of past transactions or events. And also obligations are one of the main elements in financial statements that reflect a company's financial responsibilities. The role of obligation in financial statement is crucial, as they reflect external funding sources and future payment commitments. And also, its accurate recognition and measurement on obligations form the basis of the transparency and reliability of financial statements for stakeholders. And also, the proper and accurate recognition and measurement of obligation is very important to maintain the transparency of financial statement and provide reliable information for decision making in the future. The next is concept of liability recognition. So, what is the concept of liability recognition? Liabilities are recognized if they meet two criteria, which is the first one is the likelihood of an outflow of economic resources in the future due to the settle of the liability. And number two is the liabilities can be measured reliably using defendable estimates. The recognition of liabilities is closely related to the definition of asset and equity, which is also mean that proper recognition of liabilities of asset and equity. Proper recognition of liabilities ensure that the balance of the accounting equation, which is, as we know, that assets is same with liabilities plus equity, is accurately maintained. So next is example of acknowledgement of obligation. So here are example of commonly recognized liabilities in financial statements. There are four things. The first one is accounts payable. Accounts payable recognized when an entity receives goods or service from suppliers but has not yet made payment. And number two is tax liabilities. Tax liabilities recognized when a tax obligation arises based on applicable regulation. And then number three is employee benefits obligations, which is recognized for obligation to employees such as unpaid salaries, bonus, and pensions. And then the last one, which is provision and contingencies. Provision and contingencies recognize if the likelihood of an outflow of economic resources is substantial and can be reliably estimated. And the next topic is concept of liability measurement. The measurement of liability is based on the estimate of the economic resources outflow required to settle the liabilities in the future. So there is three concepts to measure the liabilities. The first one is outflow estimation. Outflow estimation is the expected amount to be paid to fulfill obligation to creditors or the other parties. And number two is present value. Present value is future payments discounted to their accurate value using an appropriate discount rate. And then the last one is assumption and estimates. Assumption and estimates measure of liabilities heavily relies on reliable assumptions, including interest rates, inflation, and the probability of settling the liabilities itself. And next is method of liabilities measurement. So there is three methods that we use to measure the liabilities itself. The first one is historical cost. Historical cost is when the liabilities are recorded at the amount received when a liability was incurred. And then twice is present value. Present value is when the liabilities are measured based on the current value of future cash outflow, considering the discount rate. And then the last one is fair value. Fair value used in certain cases, reflecting the price that would be paid to settle the liability on the reporting date. And then in measurement of liabilities itself, there are still challenges and consideration. So recognition and measurement of liabilities face various challenges in the accounting practice. So uncertainty in the future estimate in the main absence, as the value of liabilities greatly depends on the assumption used. Each change in economic condition and business assumption can significantly impact the reported liability values. Therefore, adequate disclosure in financial statement is necessary so that users can understand the basic of estimate and the related risk. And also I'm gonna add some of the explanation about the estimation uncertainty and adequate disclosure. So estimate uncertainty is the future outflow estimate are valuable to change in economic assumption, amount rates, and market conditions that are difficult to predict accurately. And also the adequate disclosure is financial report that must disclose the measurement basis, key assumption, and estimation sensitivity to ensure transparency and reliability information. And the last one is the conclusion. So the conclusion of all this slide is that recognition of liabilities are recognized if there is a likelihood of future outflow of economic resources and can be measured reliably. For example, include trade payables, tax liabilities, employee benefit obligation, as well as the provision and contingencies. And measurement of liabilities are measured using methods including historical cost, present value, and fair value. Reliability estimation is crucial to ensure the accuracy of liability measurement in financial statement. And the conclusion of all it is the accuracy of liability recognition and measurement is the foundation of financial statement reliability, supporting transparency and informed decision making in the future. So that's all from my explanation. Thank you guys for your attention. Thank you.